Welcome to Spidell's California Minute. I'm your host, Catherine Zidane, and this week we're covering the FUTA tax increase that's coming in January. You can get an update on all of the most important California tax changes at Spidell's Federal and California Tax Update, and there's a full list of topics, and we have webinar and live seminar dates to choose from at caltax.com. Because of the unemployment claims paid during the pandemic, California is projected to owe over $19 billion to the federal government by the end of 2022 for its loan to the California Unemployment Insurance Fund. As part of the California budget deal released over the summer, California will pay $1 billion toward the loan over a 2-year period, leaving an outstanding balance in the billions of dollars. When a state has an outstanding balance owed to the federal government for 2 consecutive years, employers are required to pay additional payroll taxes. This means starting in January 2023, California employers will be paying an additional 0.3% in federal unemployment insurance tax on the first $7,000 of wages paid to their employees. This means an additional $21 per employee for FUTA taxes paid in January 2023 for wages paid to their workers in 2022. The standard federal unemployment, or FUTA tax rate, is 6%, but generally employers with a good claim rate history receive a 5.4% credit against the 6% rate, leaving the base minimum rate of 0.6%. But this credit is reduced in states that have an outstanding loan balance with the federal government for 2 consecutive years, which effectively increases the FUTA rate. The credit reduction is 0.3% for the first year and an additional 0.3% for each succeeding year until the loan is repaid. From the 3rd year onward, there may be additional reductions in the credit, although in the past, California has received waivers from these additional reductions. For wages paid in 2022, the FUTA credit will be 5.1%. According to the California Legislative Analyst's Office, it will take at least until 2030 until the fund is paid off. If the credit continues to be reduced in future years, the FUTA tax could increase to as high as $189 per employee by 2030. The repayment period could be shorter if the state pays off more of the loan directly, or it could be longer if the unemployment rates rise again. But this has happened before. California borrowed funds from the federal government in 2009, and because the state didn't repay its loan until May of 2018, California employers paid more in federal FUTA taxes in 2011 through 2017. For 2017, employers paid an additional 2.1% in FUTA taxes per employee. The FUTA rate finally returned to 0.6% when employers paid their FUTA taxes for 2018 in January of 2019. As of August 2022, California had the highest balance owed. The next state was New York with less than $8 billion remaining in debt. Only 6 states have outstanding balances. As part of the budget deal, the governor and legislators agreed to provide $500 million in small business tax relief to help combat these higher payroll taxes that will go into effect in 2023. But all that was agreed to in the budget deal was the amount of relief available. Details regarding who will qualify and what they'll receive haven't been worked out yet. You can get full details on California employment taxes, including a lengthy discussion of the employee versus independent contractor issue, in Spidell's Analysis and Explanation of California Taxes. This reference manual is available in print and online versions, and you can pre-order the 2023 edition at caltax.com under the Publications tab. That's all for this week. Join us next time for another episode of Spidell's California Minute.